Let's bring in Mike Wilson, the chief U.S. equity strategist at Morgan Stanley. Mike, great to have you back.
Thank you.
One of the few strategists doesn't have to come on our show and downgrade his market because, in fact, he had already done that.
We didn't do anything.
Yeah, good for you. Why not the all clear at this point? I mean, didn't Powell give you exactly what you wanted to hear from the Federal Reserve?
Yeah. Well, let's talk about the setup. First of all, one thing we didn't get right, we thought that we'd get to 2,400 this year. We didn't think we'd do it all in December. So the market did kind of get to our target more quickly than we thought. We thought the market would want to see the news actually come out, the stuff like Apple, the ISMs, and Skyworks, and there's going to be more of that, by the way, coming. So we got to our price, but that's valuation, right? So valuation, we met our goal. We also met our goal in terms of sentiment and positioning. It's really bearish. I mean, extremely bearish, as bearish as we've seen. But what we don't have yet is the fundamental picture is still messy, okay? So all the things that we've been worried about, the market's been worried about all year, are now starting to come to the fore, okay? So while Apple maybe isn't a surprise that they missed, the magnitude of it was a surprise, okay? And while Skyworks isn't a surprise, well, you know, that's not necessarily good news. So we'll see how it trades tomorrow. Look, our view is that the rolling bear market that happened last year is now going to be a rolling bottom. So not everything's going to bottom at the same time. And my guess is it's going to be first in, first out. The stuff that let us in will probably lead us out. So Apple was actually one of the ones that fell at the end. It's probably not going to lead us out, right? Names like Skyworks or semiconductors, home builders, maybe the banks, some of the machinery stocks, some of the early cycle stocks probably is what's going to lead. And by the way, that's what's been working so far this year, year to date, early. But I think that's really what we got to be looking for is what's leading, what's leading us out. And I think it's going to be the early cycle stuff.
When you talk about fundamentals, what is, for you, what are fundamentals? Is it Fed? Is it trade? Is it something else?
It's growth, right? So ultimately, it's earnings. Ultimately, are we going to have accelerating earnings growth? When is earnings growth going to bottom? So the two things that I'm probably most focused on right now is earnings revision breadth. That has rolled over decidedly. That was the reason we were negative last year, and it's turned down sharply. It's 8% negative the way we measure it. In 2016, which was the last time we had an earnings recession without an economic one, it went to negative 20. Tim and I were chatting before the show. I don't see how the earnings revision trajectory is going to turn up anytime soon. It's going to continue to be negative. It's just very difficult for the market to kind of, have a sustainable rally until that happens. That's point one. Point two is on the financial conditions. The other reason we were negative last year is financial conditions were tightening. Yes, Powell gave us an all clear in terms that he's now paying attention to the balance sheet, the things that we've been talking about. But they haven't done anything. So, talking about it, talk is cheap, right? Talking about it's one thing. Actually changing the behavior is what needs to happen. So they need to stop the balance sheet reduction, and they need to probably stop hiking rates for us to have a sustainable rally. And I don't know what that's going to take, but look, the further we move away from 2,500 upwards, the chance of that happening goes down, not up.
So I'm curious then, is that what you're talking about is slowing global growth? So if the Fed does make those moves, or let's just say even they cut like some people are talking about, does that change your view?
Yeah, but they're not going to be cutting anytime soon. And look, our view is that they will pause this year on the rate hikes. And I think they have to start tapering QT, so it's a reversal of QE, right? And I don't know what the timetable is on that. That will give us some breathing room for sure, and I think that's going to be very constructive. But don't forget, we're still end of cycle, right? I mean, we still have an economic cycle that we have to kind of finish. So we can only go so far. Look, I mean, the reality is that the market has been very good at pricing in a lot of the concerns that we've had. We're in a bear market, right? Everything's down 20-25%. That's a bear market. So the question now is, what does the recovery look like? Typically, when you have the kind of damage that we've had, we have massive overhead resistance now. So the fourth thing we're looking at is technicals. The 200-day moving average is turned down. Okay, now we went right to the 200-week moving average and bounced. That's healthy. But my guess is we're gonna play ping pong now between the two.
So in terms of investing in some of these first-in sectors, is it too early to do that at this point? Are you sort of wait and see, or go in on home builders, go in on semis?
That's what we're doing. I mean, we skew towards value in that belief that the value stocks are not necessarily better companies, but they priced a lot more. And it started out with a defensive rotation because people were nervous about growth slowing. Now it's turning into the cyclical parts of the market. So things like home builders, machinery, banks, some of the energy stocks for sure. Yeah, we're legging into those things now because, look, from a price standpoint, we're close enough, right?
Right.
Close enough.
Mike, thanks. Good to see you. Mike Wilson, Morgan Stanley.
You said something interesting, you always say something interesting.
I was like, it is rare.
Correction.
But
no, but you listened to the Powell interview on the radio, so you didn't realize that he was actually reading from what appeared to be a script, and you found it interesting. Right. And I've thought about that a lot. I mean, he was absolutely reading from something.
He was reading from a piece of paper.
And in my opinion, he was reading from something. He made sure he didn't miss. But it's like you tell your parents, "Don't worry, I'll never do it again," and your parents believe you for a while, but yet you continue to do it. I think that's exactly what's going to happen with Q. I think they're going to continue to whittle down this balance sheet until the market calls them out again, at which time they'll talk about being, not on autopilot. And I think that will continue for the foreseeable future.
So that means the market has more room lower.
Well, I believe so, yeah.
I'll tell you, I think the one thing the market's missed about the last week's talk with Bernanke, with Yellen, and with Powell is that they talked about this thing called price level targeting. But basically what it means is you run the economy hotter than you would normally expect to get your prices up. Now, they're going to have a conference in June. I would expect in the minutes tomorrow, maybe there's some more talk about that. But if that narrative picks up, then you get a steeper yield curve. Then you get a market that rips.
Well, I may be a bad guy, and I don't think Guy agrees with this, but I think they do need to run it hotter. I mean, think about where we came from, folks. We came from the worst credit crisis in history, arguably, and a cancer that needs to be cut out, and arguably was not, and takes some time. And look at Japan, who is still struggling with all of this. So deflation is really the devil right now. That's the biggest issue, not inflation. We'd like to have inflation. And if your New Year's resolution is to say that actually the Fed is my friend in 2019, I don't think so. So we may be aligned on that, Guy. The Fed their balance sheet is only 11% less than where it started on QT. So they haven't done all that much heavy lifting, and there's a lot to go.